Who is Emmanuel? Okay, people are already there.
one-off transactions that are capital in nature. You sell houses, you sell cars, sell shares, and things like that. When you sell them, you remove your cost of buying, and then you remove any incidental costs. Say you got an appraiser or a valuer, you remove all those costs, and then you move it from the selling price, and then you tax the balance at 10%. What's going to happen from January is that capital gains tax is not going to be taxed at the rate of your income tax. If your income tax starts 30% as a company, it means you will now be paying your capital gains tax at 30%. As an individual, your income tax rate is 15% or 20%. It means whatever capital gains tax you're going to be having will be at that same rate. So whatever rate your income tax is the rate at which your capital gains will also be taxed. Capital gains tax taxes things that are not your typical income. One-off transactions that are capital in nature. You sell houses, you sell cars, sell shares, and things like that. When you sell them, you remove your cost of buying, and then you remove any incidental costs. Say you got an appraiser or a valuer, you remove all those costs, and then you move it from the selling price, and then you tax the balance at 10%. What's going to happen from January is that capital gains tax is not going to be taxed at the rate of your income tax. If your income tax starts 30% as a company, it means you will now be paying your capital gains tax at 30%. As an individual, your income tax rate is 15% or 20%. It means whatever capital gains tax you're going to be having will be at that same rate. So whatever rate your income tax is the rate at which your capital gains will also be taxed. Capital gains tax taxes things that are not your typical income. One-off transactions that are capital in nature. You sell houses, you sell cars, sell shares, and things like that. When you sell them, you remove your cost of buying, and then you remove any incidental costs. Say you got an appraiser or a valuer, you remove all those costs, and then you move it from the selling price, and then you tax the balance at 10%. What's going to happen from January is that capital gains tax is not going to be taxed at the rate of your income tax. If your income tax starts 30% as a company, it means you will now be paying your capital gains tax at 30%. As an individual, your income tax rate is 15% or 20%. It means whatever capital gains tax you're going to be having will be at that same rate. So whatever rate your income tax is the rate at which your capital gains will also be taxed. A VAT mechanism works on an input and output basis, right? So whatever input VAT you have suffered on such raw materials you bought to produce that juice, the packaging, the juice concentrate, or the fruit, whatever it is, you have to deduct it. But every other kind of VAT, input VAT, you can't deduct. For VAT at all, input VAT, you expense it. So let me make that a bit more practical. Let's say as a service company, you bought laptops, for instance, or you got the service of a valuer. When you buy that laptop, whatever VAT you suffered on the laptop, when you charge your customer VAT, even though VAT is supposed to be an input-output mechanism, you're supposed to deduct whatever input you suffered from the output and pay the balance to government. The old mechanism or the current mechanism does not allow you to do that. So it means that you have to expense that VAT, increasing your costs because I need to do business. Capital gains tax systems that are not your typical income, one-off transactions that are capital in nature. You sell houses, you sell cars, sell shares, and things like that. When you sell them, you remove your cost of buying, and then you remove any incidental costs. Say you got an appraiser or a valuer, you remove all those costs, and then you move it from the selling, from the selling price, and then you tax the balance at 10%. What's going to happen from January is that capital gains tax is not going to be taxed at the rate of your income tax. If your income tax starts 30% as a company, it means you will now be paying your capital gains tax at 30%. As an individual, your income tax rate is 15% or 20%. It means whatever capital gains tax you're going to be having will be at that same rate. So whatever rate your income tax is the rate at which your capital gains will also be taxed. What the Tax Act has sought to do is to codify all these laws into one and try to update them based on new realities. Things have changed so far. We now have things like digital currencies, cryptocurrencies, and the likes. So the four tax acts. So we have the Nigerian Tax Act. So the Nigerian Tax Act is telling us what do we tax, right? The Nigerian Tax Addition Act is telling us how do we tax it, right? Then we have the Nigerian Revenue Service Act, which is what the FRS currently is, which talks about who we tax it. And then we now have the Joint Revenue Board, where all these people meet all together and coordinate. What the Tax Act has sought to do is to codify all these laws into one and try to update them based on new realities. Things have changed so far. We now have things like digital currencies, cryptocurrencies, and the likes. So the four tax acts. So we have the Nigerian Tax Act. So the Nigerian Tax Act is telling us what do we tax, right? The Nigerian Tax Addition Act is telling us how do we tax it, right? Then we have the Nigerian Revenue Service Act, which is what the FRS currently is, which talks about who we tax it. And then we now have the Joint Revenue Board, where all these people meet all together and coordinate. A VAT mechanism works on an input and output basis, right? So whatever input VAT you have suffered on such raw materials you bought to produce that juice, the packaging, the juice concentrate, or the food, whatever it is, you're able to deduct it. But every other kind of VAT, input VAT, you can't deduct. And for service company, you can't even deduct VAT at all. Input VAT, you expense it. So let me make that a bit more practical. Let's say as a service company, you bought laptops, for instance, or you got the service of a valuer. When you buy that laptop, whatever VAT you suffered on the laptop, when you charge your customer VAT, even though VAT is supposed to be an input-output mechanism, you're supposed to deduct whatever input you suffered from the output and pay the balance to government. The old mechanism or the current mechanism does not allow you to do that. So it means that you have to expense that VAT, increasing your costs because I need to do business. After getting
Yes, welcome, welcome, welcome. We're going live shortly, and tell your friends to join. Tell your colleagues at work to join. They need to, be a part of this educating session. I tell your accountant at work to join. All right. Okay. It is Blue November in with us at Excellium, and what that says, what that means for us is throughout the month of November, we are doing it better. We are offering 30% discount off setup and training. Of course, terms and conditions apply. Terms and conditions apply, but it is the month of Blue November. It's blue. It's raining blue throughout in Excellium. I'm navigating the 2025 tax reform. Our topic for today is smart compliance and software solutions for Nigerian businesses. Right. So we want to educate you on the tax compliance that you cannot miss out on. Right. There are four pillars of business, and on top of that pillar is the people, right? The people that would help you build your vision and the customers that you would serve, right? The second on that pillar is finance. How are you going to finance the product and services that you want to offer? And of course, the third one is the product and services. Who is the product for? Who are the skill set that you need to offer this product and services to the people you want to offer it to? And the fourth one, which is one of the most important pillar, is the laws and regulations, right? There are businesses that when you take note of the laws and regulations that are ongoing, when you take note of those rules and law, you can, leverage gaps. What are the leverage that you can make to make that laws, one of the important leverage I think stands out for me in the tax is the agriculture um, free tax. Okay, so one of the important leverage, right? So this is a time for we farmers to go back to our farmland. We are going to enjoy 5 years no tax. Of course, the focus of this webinar is to break down these reforms into how it affects different, key organizations, right? That's what makes this webinar different from every other webinar that you might have been seeing, right? So how does this compliance, how does this tax reform affect your businesses? Okay, yeah. So thank you. Please keep sharing the link. Keep getting your colleagues to join. And can you hear me, please? I want to be sure I'm audible. Uh, if you can hear me, please drop um share some your favorite react, or drop something in the question mark in the question. Okay, okay, okay. I can see Ezekiel. Um, please. Okay, Innocent Samuel, I can see you. Thank you, thank you, thank you. Okay, great, 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 great. We are ready to get started. Oh, someone said my voice is very low. Is it better like this? Am I audible like this? Okay, my voice is clear. All right, so okay. Judy, if you can increase the your volume, right? Okay, thank you very much. Right. Yes, we are ready to get started. I'll be bringing in, the time you have all been waiting for, right? Um, I'll be bringing in a speaker, right? A speaker from Moniepoint, right? Mr. Adedapo Adeduro. But briefly, before I welcome him in, I want to, introduce him. Who is our speaker? Okay, so Mr. Adedapo Adeduro is the head of tax at Moniepoint Microfinance Bank. Everybody is very familiar. If you are not using Moniepoint, I'm not sure the bank you are using. Right, so he oversees tax strategy, compliance, and advisory functions with almost a decade of experience in corporate taxation, regulatory compliance, and fiscal advisory. He has a proven track record of driving efficient tax structures, fostering stakeholders' confidence. Before joining Moniepoint, right, Mr. Adedapo served as the group tax manager at Maritime Securities Limited and was also a senior tax consultant across two big four firms, right, the big four. He's passionate about simplifying complex tax matters and strengthening Nigerian tax governance landscape, right? Please, if your reaction buttons are not too busy, I love you to welcome me, Mr. Adedapo Adeduro to our midst. Thank you, sir.
Thank you very much. And I'm grateful to everybody. Can you see me? Let me adjust my laptop a bit. Can you see me and hear me? Actually, most importantly, can you
Yes,
hear
I
me?
can see you. I can see you.
Okay, and hear me clearly, because I know some people complain about the volume. Is my voice audible enough? You can have one or two reactions or responses. Okay, I think we've had. Okay, good morning once again. As Paul has just introduced, my name is Dapo Adeduro. I serve as head of tax for Moniepoint MFB, Moniepoint Microfinance Bank, and its other related companies in Nigeria. I want to say thank you to Excellium for having me. I would go right into it and present my slides. I'll put off my video at this point and put it on at the end. Okay. Can you see my screen and still hear me? Anybody can just answer. Hi. Hi, Paul. Can you hear me?
Yes, I can hear you.
Okay.
Now, please,
And you can see my screen.
turn up the reaction if you hear him too.
Oh, okay. I can't see the reaction. So that's what I'm going to say. You can see my screen, right?
Yes, I can see your screen.
Okay. So I'll put my presentation on full screen mode. That's why I switched off my video. So if anybody has any question at any point in time, you can please, oh, I don't know, how do you want to run it, Paul? Do we wait to the end, my presentation, or do we just have to interject as I go through?
No, go on, please.
All right. So I've been told I have 40 minutes. I don't know how we'll do it, but I will try to ensure we cover it. So I'm sure the Tax Act, the new Tax Reform Act is not strange, to us. Some of us may have in-depth understanding of it already. Some of us have surface level. Some of us will never understand it at all. There's been a lot on social media, about the act. Many of it, maybe not most, but some of it misinformation. People trying to cause mischief by, misinterpreting some of the acts. So the acts, before I go into the introduction, okay, let me just go right into it. In June, when President Tinubu came in 2023, he decided that tax was one of the core pillars of his administration and wanted to reform, the tax. So he brought in an expert, Tayo Dele, who is one of the foremost experts in tax in Nigeria. Anybody who is in tax knows who Tayo is. To head the committee. It's a very large committee, right? Most people only know Taiwo because he's the one who is the spokesperson always talking. But that committee has about 150 members. So there are a lot of people in the committee, including students, big fours, different representatives from everywhere, right? So the committee came together. I did what I would call a consolidation of our laws. So Nigeria's laws, some of them are very old. I'll give you an example. The Stamp Duties Act that we use as of today dates as far back as 1959, or earlier actually, the 1930s. So if you open the Stamp Duties Act, when they're talking about amounts to pay, apart from the one that are percentages, you'll be seeing 20 naira. When you're talking about penalties, you'll be seeing 1 kobo, 15 kobo, 20 naira, which was big money then in the 30s and 20s. When the naira was equal to the pound, or even more value. But times have changed, and so because of that, the tax authorities could not implement the Stamp Duties Act because when the penalty or something is so low, then why do I have to disturb myself? I'll just pay the penalty and move on, right? And then in terms of also our economy, the committee was trying to ensure that we don't tax capital, and that's your investment amount, don't tax it. And we try as much as possible to exempt, low income earners and businesses from paying tax, while the higher income earners and companies would bear the brunt, so we pay a little more. So that's where this whole law came into effect. So together, there are four of them. The four of them together is over 400 pages. As I said, not everything is new. Some of them are retained from the different acts. So it repeats a lot of acts, maybe 20 or so acts, and then consolidate those acts into these four. And then by doing so, we have one codified tax law that's modernized, at least to some extent. It's not perfect laws, but we've made some progress. So the four acts are the Nigerian Tax Act. This tells us, it talks about what we want to tax. We want to tax income. We want to tax transactions. What are we taxing? That's the Nigerian Tax Act. That's where you will see the PIT rates, your CIT rates, your VAT rates, and different things like that. Those are the things you will see, in the Nigerian Tax Act. The Nigeria Tax Administration Act talks about how, would tax them, so the mechanism for taxing them and how you go about doing that is how you administer the taxes. The Nigerian Revenue Service Act talks about who will administer the taxes. So the Nigerian Revenue Service Act is
it repeals the FIRS Establishment Act. So in other words, the FIRS is going to become the Nigerian Revenue Service from January 1st. And so it gives them a little more powers in certain places, takes away a little bit powers in certain places just to, modernize them. And everything here is brought together in the Joint Revenue Board Act, which unifies, all the taxes, unifies all the people, brings together the federal government, the state government, and local government. Because under our constitution, the 3 tiers of government tax separately. They have separate taxing powers. And what should be the first misconception I will correct? On social media, people mix up a lot, the two. The FIRS is entirely different from the state internal revenue service. And so a lot of times social media, especially on Twitter, people complain about the FIRS coming to tax them. And I keep having to mention that, see, the FIRS has nothing to do with your income. Except you're a member of the armed forces, or you are a non-resident person in Nigeria, so you don't have a state. You came from Brazil, for instance, come and work in Nigeria, so we can't give you a state, so you pay your tax to FIRS. If you're part of the armed forces or the police, as that national body, you pay your taxes to the FIRS. And if you're a member of Nigeria's foreign office, so you're a Nigerian, but we've seconded you to the embassy in the United States to go and work. Your taxes, because as you well know, embassies are still part of the country. So Nigeria's embassy in the US is Nigeria. That building is Nigeria, as well as Nigeria's embassy in every other country. So it means because you are in Nigeria, even though you are fiscally in the US, your taxes is due to Nigeria. So it means you will pay taxes to the FIRS because you're not in any states. But apart from those 3 categories, every other person, your taxes, your personal income tax is due to your state government. And so if we talk about the FIRS coming for them, I'm like, no, the FIRS comes after companies, and deals with them. But that's by the way. So the final copy of the, there was a lot of mix-up here and there. There were different copies. One of the first issues that the committee faced, different copies. But I would enjoin everyone, if you want to get the final copy, please go to Google and just type in the Presidential Committee on Fiscal Policy and Tax Reforms. It will bring out their website. Click on the website and you will see it right there, the final copies, because there are a lot of copies and some of them have information that are outdated. That's why people are going back and forth on social media because people have the wrong versions, And one of the ways the correct version is on the top right of the first page. It's minuted there. I can't remember because I think it's gazetted copy or something like that. It's minuted on it. That is the gazetted copy and the final one. So let's just dive into it, the impact analysis itself. So I'll start with this payee because that's what people are really most concerned about. Even though on this call, we'll be talking more about companies because here we are here to talk about companies. So overall, I have about, as I said, the acts are 400 pages, 400 plus pages. So we can't even go through the entire changes. There are a lot of changes, right? That's one. Number 2, even the changes I have put here, about 20. And because I'm not driving for quantity, I'm driving more for quality. Within the time frame we have, we may not be able to finish it. So I'll leave my slides, with the Excellium team, and maybe anybody has any questions, you can go through it. Anybody has any questions, can reach out to me. I'll just take my time to go through each one. And then at the question stage, people can let me know the things that are bothering them that we can now answer, so that I don't just rush through and then it seems I've not passed any knowledge across. So that being said, I'll start with payee. Like I said, I know we are discussing companies here mostly today, but it also affects companies because employees run the companies, right? And each of us here are also in some way employees. And even if you're an owner, most likely you're also drawing a salary. So you'll be subject to payee. And even when they pay at the end of the day, you will still pay payee, even though it's not under any employment. So basically, what has been done under payee is that the system of computing has been changed. So first off, I'll start by saying what we call the consolidated relief allowance has been deleted. So under the current regime, that will still occur until December 31st, there's something called the CRA. I'll call it CRA for now, consolidated relief allowance. It allows you to deduct 20% of your gross income plus 1% or 200,000, whichever is higher. So if 21% of your gross income is higher, you take 21% as a relief. If 20% plus 200,000 is higher, you take that as a relief. And then you complete taxes on the balance after removing other reliefs that we may have or you may have. But that has been deleted, like totally. So we don't have CRA anymore. So what I have now done is to introduce what we call a tax exempt threshold of 800,000. If you look at the two tables below what I wrote up here, the one to the right is the proposed, not proposed now because it's going to start on January. It's no longer proposed, it has been signed into law. So it's what will happen from January 1st. The one on the left is what happens currently. So you can see that on the left, there's no 0% band, but there's not an 800,000 0% band, which means the first 7,000 of your gross income is not taxable. Secondly, the laws have introduced a new rent relief of 500,000 or 20% of your rent, whichever is lower. So it is rent relief capped at 500,000, but it can be lower. So it means your rent has to be at least 2.5 million for you to be able to get the full rent relief of 500,000. If you pay rent of say 1 million, you only get a 200,000 naira relief because that's 20% of your actual rent paid. And then the rates have changed, right? Before we used to have the first 300,000. So personal income tax is computed on a graduated basis. It's not like company's income tax where you calculate your profits and then you get your taxable profit, you deduct your capital allowance and everything, and you just apply one rate, 30% bam on it. This one for personal income tax is graduated. So it starts on 7% currently. If your first 300,000, these are annual, so they are small amounts. The next 300,000 at 11%. So you keep going like that, graduating. If you earn anything above 3.2 million or your taxable income after the reliefs have been deducted is more than 3.2 million, you will tax whatever balance is left at 24%. But this has changed. The rate is now graduated from 0%, like I mentioned, to 25%. What this has done essentially is just mathematics. They use mathematics to kind of shift the burden. So if you earn anything from like 1.5 million, 1.7 million a month and below, your taxes will go down because your taxes will fall before that's earnings. You already be falling 24% on the left table because if you get above 3.2 million annually. But on the right, you probably stop at 18%. So by the time you add 800,000 plus 2.2 million plus 9 million, it may cover for your entire annual salary. So because of that, you will fall into a marginally lower band. It's not going to be a lot, but it's just something to just encourage and say, see, we see you, and we want you to have a bit lower taxes. If you earn anything from 1.5, 1.7 million, and I keep saying 1.5, 1.7 because in tax, you can never know exactly. We have different reliefs. The way your pay is structured will be different. Some people may have mortgage, some people don't have. Some people have NHF, some people don't have. So even if me and you earn, our offer letter has the same gross, our tax may not be the same, depending on how our company runs our payroll, right? So that's why I'm just putting a range of 1.5%. But if you're anything from above that, then your taxes gradually begin to go up. It will also be marginal. It won't be much, right? But I must mention that marginal is relative. If you are somebody, you're a CEO, and you're earning, I don't know, your total gross in a year of a big company is 1 billion, then your own marginal is probably going to be my entire salary for the year, right? So it depends. So the higher you go, the more your tax increase. So the idea is the rich to subsidize the poor. Let's give the poor less to pay and the rich more to pay. So that's basically around the, as a company now, talk about the impact on company because we're here to discuss companies, right? So for your company, the first thing is that your wage bill remains the same. It doesn't change. So for the employees who are paying less, the only difference is that you will pay them more gross. You pay them more net salary, yes, more money, right? For those who are, they are paying you. Sorry, you're saying something?
Yeah, then actually, they should come tell you that they're paying us.
Yeah, please go on. Please go on. Sorry for that interruption.
Can you hear me now?
Concern.
Yeah, I was muted, so I had to stop my screen sharing.
Okay, sorry.
Okay. Okay. All right. Let me go ahead. So for those who their pay will go up a bit, you will just pay them. You will just pay them less, so they will be earning a little bit less. So the wage, from a company perspective, you are not going to have more amounts to pay out or less. There will only be two scenarios where that can happen. Number one, if for those people in your company who their pay will be going up, you decide to up top their pay so that they still retain the same net pay, then it means your wage bill will increase. And then if you have signed contract with employees where you've agreed payments, salary with them net of taxes, then it means whatever change happens in the tax, you will bear it. If it's an employee that their pay is coming down, then lucky for you, you will save small money. But if it's an employee that the taxes is going up, then you have to fork out money to pay the tax because you've agreed to pay them a particular amount, right? So that's basically it around pay. So I move on to because we're discussing more as a technology company, I just brought out a little one or two technology, impact of the act. So for non-resident employee, if you are employed by a startup or you are employed by a company that is engaged in technology-driven services or creative arts, that your employment is not taxable in Nigeria if it will be taxed in your country of residence. So basically, this is just for startup industries, tech companies, creative industry. They're trying to say for these industries, companies operating in these industries, you understand that you may not get the expertise you need in Nigeria, right? There are some new technology services you have in Nigeria that are coming up that you can't get experts for them in Nigeria, or even if you get, they are scarce, they're not enough to drive your company. So you still have to get expatriates for them in time. So Nigeria is saying we would encourage you by those employees, those guys that are going to be coming in, into Nigeria to work for you. We encourage you by saying we're not going to tax them on their employment income. So you are encouraging them. So if somebody in a country X wants to hire an employee from the US, and me in Nigeria, I have a company, I want to hire an employee from the US to both of us. If country X does not have this provision, it means country X will be telling that person that, oh, you are coming here, and both of us are offering the same amount. You are coming here, you'll be earning 10 million, but your take home will be 8 million because you have to pay 2 million tax. Me in Nigeria, I'll be telling that, oh, in Nigeria, you're not going to pay any tax. I'm going to pay your 10 million gross because there's an exemption for you. So it kind of encourages me and gives me an edge. A person will take Nigeria, like, oh, okay, if it's tax free, then why not, right? So that's the idea behind non-resident employee exemptions for technology-driven services and startups. The next one is also around employees. So this provision exists currently, but what has happened is they've now strengthened it, and so there may be punitive measures around it. So employees have to file their individual taxes, and these people get it wrong, right? Sometimes. So in Nigeria, when it comes to personal income tax for companies that have employees, there are two different important dates, and they are separate. There is the January 31st, where the company files their own employer returns. That's why you hear things like Form H1, used to have Form G. I don't think we have it anymore, right? Many states have now automated it online now. Just file online with the Excel schedule in CSV format. So what you are basically doing in this January 31st filing is, as a company, you are saying over the last 1 year, January to December, I deducted payee from social number of employees monthly. This is the details of those employees. This is their tax ID. So if employees are in 10 states, you file taxes to 10 states because, like I said, personal income tax goes to state of residence, right? So you say these are the companies, these are the states, and you file to those states. These are their tax IDs, this is their position, whatever details they need, and you file. So that's what you're filing. We tie with all the payee receipts from the year. Payee is deducted monthly on a monthly basis. So by the time you add up the payee that you've paid from January to December, it will add up to your schedule of what you deducted, and then you file. However, there is a second date that people miss, especially employees, which is March 31st. March 31st now means those employees themselves will now go to their state of residence, the tax authority there, and file their own individual returns. So this has been strengthened in the law. They even specifically mentioned employees because it's something people miss. So people feel like once my company files, I've moved on. That is not the case. We saw it a lot at the LRS level this year and last year because at the point there was a lot of mismatch in the FX market. The black market rate was far higher than the official market rate. And for you to access the official market, you needed to get a TCC because as far as Nigeria was concerned, you are not going to cheat us twice. You are not going to not pay your tax. And then you now want to come and get subsidized FX rates that people who are paying tax will pay for, right? So you want to come and get subsidized dollars to pay for your school fees, bring your TCC from Nigeria. So people rushed to tax authorities, came to disturb we tax managers then to get TCC. It was then they discovered that they had to file their own personal returns, something we've been mentioning for a while and people are not doing. So this is just something of note that people have to do. So you go to your residence, you file your personal returns. So the individuals will file their returns from the employer and any additional income. So as an employee, your employer will have filed the deducted payee from you. Or you, when you're filing, you will file that payee, that deducted the payee, and any additional income. So you have your own side hustle, you invested in one thing or the other that has income, you file it there and you pay. If there's anything to pay. Okay, I think I should move a bit faster. CGT has been a very big topic on social media. I'll just briefly run through it. So what the new tax laws have done is the CGT rate now mirrors the income tax rate, right? So they try to remove that dichotomy between capital gains and income tax, profits. Reason being that they're trying to encourage people to do actual business and discourage speculators. So if capital gains tax is 10% and income tax is 30%, why don't I just go and buy land somewhere and tie down the money, right? Instead of doing business and then wait for it to appreciate, sell it and just pay 10%. Instead of going to do actual business, sweating and make the money and you're taxing at 30%. So they are removing that dichotomy so that people can be encouraged to say, okay, there's no difference. Let me just do business and make more money faster, right? So the CGT rate now mirrors income tax, which means for companies, your CGT will either be at 30% or 0%. 0% because we'll come to that there are small companies that are now taxable at 0% CIT. Well, not now. It exists currently, but they've increased the threshold, right, for small companies. So if you're a small company, income tax is 30%, is 0%. Your CGT with 0%, no matter what you sell, right? And if you're a big company and the CGT rate is 30%, your CIT rate is 30%, your CGT rate will also be 30%. There is an exemption of tax on share proceeds below 150 million and proceeds of 10 million. There's been a lot of talk around shares. So sale of shares fall under the CGT regime, which is that we were complaining that the increase in this will affect their personal investment portfolio. But it's an exemption for small taxpayer. However, I see that this and that I highlighted, my bolding is very important. What the law says is, if your share proceeds is below 150 million and the gain, the proceed itself, you are making, the gain is not proceed, rather gain of, I'll correct that, of 10 million naira, then you will be exempt. So what this basically means is, if I sell shares of 80 million and my gain is 20 million, I will still pay CGT. Because even though I qualify for the first threshold, my sale is below 50 million, I don't qualify for the second. So there's an and there. In law, when you say and, it means that the two have to be taken in conjunction together. I think what they wanted to put was or, because anytime the committee is communicating, they keep saying or. So I hope that will be changed because, when it's time to file, they won't look at what the committee said, they look at what's in the law. Another good thing is that your capital losses can be deducted against your capital gains, unlike before or unlike currently. So if you invest in the NGX, you bought Zenith Bank and GT Bank, and somehow Zenith Bank made a loss, GTB made a gain. Currently, we will tax you on GT Bank and we'll just close our eyes if you did not buy Zenith Bank. What will happen is from January, you can say, oh, I made 5 million loss when I sold my Zenith Bank, and I made 10 million gain when I sold my GTB. So I have only 5 million to declare, right? They've now also expanded the disposals of the asset classes. So one of the major changes we have in this law is that they've brought in a lot of digital and virtual assets. In fact, there are specific provisions that talk to virtual assets. So when you talk about your cryptos, as the Web3 industry, your cryptos, your NFTs, and the likes, cryptocurrencies and the likes, Bitcoin and co, they are now taxable. I think it's something that Nigeria is really looking forward to, and has got sort of opera, online. So it doesn't expand to include. So if you sell your digital assets, you sell your Bitcoin, it's not subject to CGT. There's a reinvestment relief. If you buy shares, a Nigerian company shares, and you sell, if you reinvest those shares, if you reinvest that money in another Nigerian company, then you will not pay CGT yet. It's like a rollover relief because you've reinvested the money. We'll hold on until you finally sell and don't reinvest, and we collect, the CGT. If you invested part of it, you will pay tax on the part that you did not reinvest, and then you suspend the part that you reinvested. There's a new announcement by the tax committee of the cost rebase. So if those of you who are active in the Nigerian Stock Exchange would remember that over the last 1 month, not even remember, it's still currently ongoing, there's been a raid all over the place. Analysts are saying different things, but some people are saying it's because of the announcement of the CGT of 30%. Some people are saying it started when Trump, mentioned the whole issue around Nigeria. So whatever the cost may be, I think the committee took that and the Minister of Finance into account and said, oh, we're not going to rebase your cost to 31 December. What that means basically is we are going to warehouse whatever gain you've made so far up on 31st of December. We will not tax it, so that we are not applying this 30% CGT or income tax rate CGT retrospectively. Right? So if you have a share that you've had for 10 years and you've made 100 million gain on the share, by 31 December, we'll warehouse that gain. So your cost when you start counting from 1st of January, right? Yeah, so that's it about CGT. I think I need to move on from that. What have I not spoken about? So like I said, it measures your income tax rate. So for a company, 30%, if you are paying at 30%, you're a small company at 0%. If you're an individual, whatever base, you fall under, we talked about it here. If you fall under the 15%, 0 to 15%, that's how you tax your CGT. If you go up to 18%, that's how you tax your CGT. So for individuals, your CGT rates will depend on where your tax bracket is. So the more you earn, the higher your CGT. So it can be anything from 0% to 25%. Okay. We move on to fiscalization. So fiscalization is basically saying that the tax authorities, both at state and federal level, now have the authority to deploy third-party applications to get either the data or whatever thing they need from your system. So unlike before, where FIS has to wait for you, they tell you and say, oh, we need your invoices for the year. You will now go and, and start gathering invoices and everything. FRS and states may get to a point where they will now deploy technology to get your invoices real time, the way they can get your bank statements, they can get your invoices. So the law says if they write to you that they want to use their third-party applications to access your systems, you have 30 days to grant them access. If not, you start paying penalty and then the millions of naira. FRS has commenced with what we call the e-invoicing. That's like a fiscalization measure. The invoicing is basically saying that we are going to use our API or whatever thing to connect to your system as a company, so that when you issue invoices, those invoices will be issued electronically in real time. So if I have connected to FRS invoicing platform, for instance, and I'm active on it, if I sell phones, if somebody comes to me and say, oh, I want to buy an iPhone 17 or an iPhone 16, and it costs 3 million, right? When I go into my system, because the API is plugged directly to the FRS, when I go to my system and I type, for it to generate an invoice for me to send to the person of, 3 million for the person to pay, it goes straight, I don't know how fast it will be, maybe seconds, into the FRS system. The FRS system stamps that invoice, not physically, electronically, with a number. So it gives it a unique identity number. And then you can issue that invoice to the person that wants to pay for the phone. Two things that does. One, FRS automatically has a record of your invoices. And two, they automatically have record of your VAT and can collect it directly. because they now have the invoices in there. So when you're coming for an audit, there's no need to go back and forth. They will tell you over the last 1 year, you've invoiced invoices of 3 billion naira. So you can't say, oh, it's less or it's more. And if it is, you have to explain why. Maybe somebody didn't pay, something happened, you didn't supply, things like that. They are starting this with large taxpayers for now, right? Large taxpayers are those in the large tax office, the MTNs, the banks, the Guinness, other big companies. But eventually it's going to come down to everybody when those people have it, and it's well done. The issues around this is about, my data, how will they handle it? But then the laws have also put in strict measures against FIRS and other tax authorities where they mishandle, customer or taxpayers' data, or where there's leak of confidentiality or something like that. So there are now strict measures against actually the FIRS. So you can go to court and sue them if you feel like they're either infringing on your personal data or they're infringing on your company confidential data. Okay. So we go to some activities. This is a quick one. Under the new tax laws, they have expanded what electronic and digital services are. It covers e-commerce, your app store, your high-frequency trade. You are storing data electronically, online advert platforms, gaming, what have you. There are many. I didn't even list all of them here. Cloud computing, online teaching, those people that do, remote work and teach online. A lot of things have been expanded to include it. So they deliberately increase this to increase staff-level service, the influencers online, right? And so on and so forth. So they are capturing this activity. So there's no unfairness in the system. The nature of your job should not determine if you'll be taxable or not. As long as you earn income, then if you are granting exemption, let's grant to everybody. So you cannot say because you work in the crypto industry, you will not pay tax. I work in the financial services, I will pay tax. So that's the idea behind expanding the definitions of taxable services to cover as many things as possible, especially as you now exist in a digital world, right? Another thing to note is that when it comes to digital assets, your cryptos, NFTs, and the likes, the losses from those digital assets can only be offset against the gains from the same assets. So what that means is, I think because of the volatility in these kind of assets, they're very volatile. They are trying to warehouse those assets, from a Chinese wall. So you will not say because you invested in Bitcoin at 100,000 and then Bitcoin is now 20,000, you are not having any tax to pay for the year. You've used all the losses on the Bitcoin you bought to come and offset your PIT. So they are saying no. Those are volatile assets, so we are warehousing them. So if you have any loss, you can get it from the gain and then pay tax. But if you're lost from your gain, then you're on your own. You're not going to offset that loss against other kinds of taxable service or goods. Moving on technology as well, there are now something called a virtual asset service provider, a VASP. So these are taxpayers who are involved in either in the exchange, trading, custody, or issuance of virtual assets. So these assets talking about your digital assets, your cryptos, and the likes. So if you are somebody who you are involved in bringing customers together to exchange this, you must register with the FIRS at the VASP. You must obtain license from SEC. So you can't just go online and type anybody has airdrop, anybody has Bitcoin for sale. Connect people. If they decide to enforce the law, you may be in trouble for that because you have to get license from SEC. This has two measures. One is for anti-money laundering, because as we all know, because of the decentralization in the crypto, and virtual asset space, a lot of money launderers and people with bad intentions use that to move funds. So they're trying to bring all that industry. And Nigeria is one of the highest adopters in the world of crypto and the likes. But if it's not for the CBN issue and Bitcoin issue that happened a number of years ago, I'm sure by now probably we have number one, number two in the world in terms of adoption. We have really adopted, digital assets in Nigeria. It's a big thing for us. So they are saying that they want to ensure that you're able to get personal data, So as a VSP, you also get personal data of customers and file. I don't know how this will work because I'm not really an expert in this space, but I understand a lot of distribution happens. But when you come in contact with a centralized exchange, then your data has to be collected. And I believe they're going to treat VASPs as centralized exchanges, the way Bitcoin is. So if you have a Bitcoin wallet, don't take this, as word, because I don't have any in this space. Once you have a Bitcoin wallet, you're not using any exchange, then that wallet itself is decentralized, and it's the identity is not known. I've forgotten the word that you use now. But if you now want to exchange some amounts from that Bitcoin wallet and send to somebody else, and use a central exchange like Binance, then Binance has to get your personal data and file the FRS. So that brings you from the decentralized part of the crypto and Web3 market into the centralized part. So this affects crypto industries, financial services, technology companies, and the likes. There's an exemption for national currencies. So if you think about it, our national currency is sort of decentralized in a way, because in my account now, for instance, I have a Moniepoint account. I have there sitting, say, 5,000 naira. I don't have 5,000 naira cash anyway. It exists on a system in the CBN books and Moniepoint books, right? So in a way, it's electronic, but they are saying those are exempt. And CBN e-money is also exempt from this. All right, moving on. Hope I'm not moving too far. I see time is running. Sorry, are we clear so far? I'm talking to myself.
Yes.
Need response,
we do
please.
have
Okay.
questions. You have questions.
Questions,
I
right?
want you to go around, finish up, then we'll move to the question and answer session.
I didn't get that. Okay, we'll move to the all right, no problem. So some of the question and answer session. I think that's where we'll spend a bit more time so people can ask us actually on their mind. Like I said, we're not able to go through everything here. Last week I was in a training, an offshore training, where we looked 1 week in Kenya, where we look at it, and we did not even cover anything, and it was a whole week of training. So it's a lot, like I said. So we definitely can get to 20 in 45 minutes. In fact, if you give me 3 hours, I'm not sure we'll be able to get to 20. But I've just codified everything here for people to have. So wherever we're able to stop and take questions that actually are on your mind, it's fine. So you can stop me at any time. My time is up, please. All right. So moving to the number 8, we have what we call not what we call, but under the new laws, we have harmonized taxpayer base. So if you look at the Tax Act, what we have in Nigeria currently is what you call your tax identification number, which you call TIN, right? So if it was your TIN, what was your TIN? It's a company. But the Tax Act deliberately mentioned tax ID. And it's not different, but it's distinct in a way. So your TIN will still be valid from next year. Nothing will change. However, what the tax ID is trying to do is make the TIN, the TIN system, a bit more wholesome. So instead of having just TIN, we can use other unique parameters or identifiers that you have to tax you. So your NIN can be a tax ID. Your BVN can be a tax ID. Your driver's license can be a tax ID. The idea is to get to a point where Nigeria's system, I hope we get there soon, because as you well know, implementation, we are very good at writing laws. Nigeria has very good laws, but implementation is usually the issue. So if this is implemented well and soon, we'll get to a point where all your unique parameters will be part of the tax system. So the FRS or the authority don't even have to get your pay ID or your tax ID. They just input your BVN and it should bring out all your details. The idea is you cannot hide. So, for instance, you go and file with the LRS. You reside in Lagos State, so your tax is due to the Lagos Internal Revenue Service, LRS, right? And you tell them that my entire income for this year, employment and unemployment, is 30 million. You understand? In the system we are moving to, LRS can just input your details, your BVN NIN into the system, and it will bring out all your touch points with the entire Nigerian system. So it immediately show that when they input that your BVN and NIN, it will show that customs registered in your name a car that came into Nigeria in that same year, a Lexus bulletproof car of 500 million, right? Meanwhile, when you went to the IRS to tax, to say you had just 30 million. So LIS will simply just write you, a tax letter and say, Mr. Adedapo, You said you only have 30 million income in the year, but when we checked your details, custom showed that you imported the car with value of 500 million. Explain, maybe it's a gift, maybe you stole the money, whatever it is, or, you have to declare. So that's the idea. We are trying to ensure that we use big data in bringing into the taxnet, harmonized tax database. So, and they will move to more automated returns. In Kenya, for instance, they move far ahead in terms of technology than us. You don't have to file things like VAT manually. Everything is codified in the system at every point. Either you go to supermarkets, either you import something, everything is already in the system. At the end of the year, the system will, or the month, rather, VAT is filed monthly. End of the month, the system will automatically collate all your VAT. And even in Rwanda, it's even far more technical. The system is so good that when you have more, so VAT works on an input-output mechanism, right? When you buy something, they will charge you VAT. When you sell, you will charge VAT. So you are going to pay the balance to the tax authority. So if what you've bought, the VAT is 10 million, and what you've sold, you've charged your customer VAT of 20 million, you are going to pay the FRS the 10 million balance. In Rwanda, you're not paying FRS. In Rwanda, the system automatically computes that VAT and files. You just click yes, just to confirm that you are fine with the returns that the system has compiled. And if you have a refund, so if the one I mentioned, your output VAT of 20 million was higher than your input of 10 million. But let's say in one particular month, you're the kind of company that you don't sell like that. You're not in the consumer goods. Maybe you do houses or something, and your sale is just once a year. So for all the months that they've been charging you VAT, and you are not charging anybody because you've not sold anything yet, the system will automatically calculate a refund for you, and you get a refund in your bank account without having to go anywhere. So that's where the system is moving to in terms of this harmonized taxpayer base. We do something that we should not be disturbing FRS for. You call your tax accountant and they say, we are going for a meeting. Some things don't need meeting. If everything's in the system, it will harmonize it and automatically calculate it, right? So on to the next one. Like I mentioned, there's exemption for small companies, right? So small companies are now exempt from CIT, CGT, and the newly introduced development levy, which I'm not sure we'll get to, but there's now a new development levy of 4% that replaces a lot of levies that companies pay, like education tax, NSENI, police trust fund, and the likes. Now, the question is, a small company, so to define a small company in the laws, we use revenue threshold. So the question is your revenue threshold for exemption 50 million or 100 million? At the beginning of the session, I mentioned that a lot of things, we have different versions of the law, right? And even the final version we have, many things change. So when the proposed laws went to the National Assembly, the House of Rep and the Senate, by the time it came back to the committee and Mr. President, a lot of things have changed. So they had to do a lot of cleanup. But because they had to release the act on time, so that people can have it, they could not clean up everything. So, for instance, there are two different definitions of a small company. The Nigerian Tax Act defines a small company as a company with a revenue threshold of 50 million and 250 million in assets. The Nigerian Tax Administration Act defines a small business as a business with 100 million naira revenue threshold. Right? So, clarify first, the intention is 100 million. That is clear. They plan to do 100 million. But in writing and drafting, the initial proposal was 50, and it did not change at some point. So the question now is, when you have a revenue threshold of 75 million a year, what do you do? Right? Do you pay taxes, or do you rely on the fact that the intention was 100 million? I'm of the opinion that before people file, because filing is till June, there should be like an addendum, amendment passed to make this clear. Because in my experience as a tax, person over the last 10 years, nobody cares what anybody said. In fact, I have been in meetings and in cases where the FRS is disputing what the Minister of Finance wrote. Let's put that in perspective. The Minister of Finance is the supervising minister for the FRS. The FRS is an agency of the Federation that sits in the Ministry of Finance. So the chairman of the FRS reports to the Minister of Finance. And if you read our laws, the VAT, the CIT parts, they give the minister some powers. One of the powers it gives the minister is to release what you call a VAT modification order. You know, if we want to include some things to VAT exempt, zero rated, we don't have to wait for National Assembly every time because some of these things are moving. We need to do them now. You know, maybe we decide that we want to start exempting people who bring in solar. You know, it's already exempt. I use as an example, and Nigerians are using solar a lot. We can't wait. National Assembly will take another 6 months. But Nigerians are buying solar now, and we don't want to pay VAT. So that's why the VAT Act gives the Minister of Finance the power to come out with a list and say, I am modifying the list of exempt, goods in the VAT order, and I'm including solar items. So from today, if you bring in solar items, you will not pay VAT. And the minister doesn't have to wait for somebody. Do you believe that when the Minister of Finance, then I think it was Zainab, released the modification order, there were some things in there, I'm not going to specifics, that the FRS disagreed with. I've been in meetings where the FRS said, no, the modification order cannot trump the law. If the law has said this, that means that person is not exempt. They don't care what the Minister of Finance has said, right? And I've been in other meetings where the same FRS, maybe a different team, will tell you that, oh, the minister has released the modification order, that's what will follow, right? So that comes to tell you that there cannot be ambiguity in the law because our own tax authorities, we hope they change, but our own tax authorities will interpret whatever it is written there into their own favor, right? When it should be to the favor of the taxpayer normally, when there's an ambiguity, it should be resolved in the favor of the taxpayer. But in Nigeria, sometimes it's resolved a lot of times actually in the favor of the FRS or the tax authority. So that is why things like this have to be clear, especially because of the small companies that we have, right? So moving on, this exemption for the small company, this 100 million, let's assume they are going to say 100 million and amend this. This 100 million revenue threshold, I think is an incentive for companies to formalize, business names to formalize. Nigeria has a very big informal sector, and the informal sector is mostly outside the system, both for funding and for taxing and for different things. So as a business name, you are going to file your taxes under personal income tax. And if you look at the table that I had here, you can see that the only exemption you have is 800,000. So Dapo Limited, I have a company. I sell cakes, right? I bake and sell cakes. Paul Limited, he also has a company, but he also bakes and sells cake. We do the same business. In fact, our shops are beside each other. And we are both so good that during the year, both of us made sales of 80 million each. Our revenue was 80 million each. But Paul registered his own business as a business name with the CAC. I registered Dapo Baking or Dapo Cakes as a limited company. What this exemption means, let me go back there, number 9, is that if you stick with the 100 million threshold, it means I will be tax exempt because I'm a small company under the law. I will be tax exempt. But Paul will pay tax at up to 25% because there's no exemption anywhere in the personal income tax for that kind of threshold. So what that means basically is they are trying to, I don't want to use the word force, but encourage business name to formalize and come into the formal part of the economy, right? Because if you look at yourself and say, I sell clothes at Nigerian and the likes, and my revenue may not more than 100 million, why don't I formalize and become a limited company so that I can enjoy exemption and not pay any tax at all, rather than stay as a business name and then pay tax of up to 25%, which can be huge, right? And so it's an incentive to formalize, but it also comes with additional compliance costs. As we all know, as in our various companies, when you become a limited company, you are now liable to be assessed and administered taxes by the FRS, and that means a lot more compliance costs. As a business, you can get away with the law because let's say that it is many of our states are not really serious when it comes to taxation. Right? Many people don't pay tax and they're okay with it, so you can dodge some things. But when you come into the federal system, FRS is a bit more efficient. It means your compliance costs may increase, right? You have to get a tax professional, you have to get an accountant and the likes to ensure that your records are up to date on the FRS system that we call Tax Pro Max. So that's basically about the exemption for small companies. I'll move on now to number 10. Paul, please, how long was that?
Okay.
Stop me
you
here,
have
Abby.
about 5 more minutes. Yes, but I
Ooh.
you are going somewhere.
Okay,
I want
let me skip
those
this.
is 5 more minutes so that we move
Okay.
to question and answer.
All right. So I'll just rush through the rest. The Economic Development Tax Incentive is a new scheme. They are phasing out pioneer status incentive. Current pioneer status incentive means you will not pay any taxes at all. Once we grant you personal pioneer status, which is PSI, you will not pay taxes for 3 years, which is extendable to 5 years, right? Even if you make so much money. We are saying we don't want that kind of incentive anymore because it's unfair, right, to taxpayers. Instead, they're now granting a tax credit where we'll give you 5% of the capital you have incurred in certain industries. We call them priority industries. Agro-allied manufacturing, technology, innovation, healthcare, education, there are many of them. They are priority sectors. If you invest in these sectors, you can get 5% of your capital. As you invested 200 million to establish a company in the education sector, you can get 10 million as tax credits and carry it for 5 years. Yes, it's very important. So certain deductions not allowed. We are moving to a system now where if you don't have VAT, if you don't pay VAT, you will not be able to deduct the expense. And if it is a item of capital, like it's an asset, you will not be able to claim capital allowance. So you can either claim an expense as capital allowance if it's an asset, you bought chairs, furniture, laptops, and the likes. It will not be direct expense to come as capital allowance in your tax returns. And if it's an item of expense, small items, repairs, and the likes, come as expense. If you not pay VAT on it, you'll be able to deduct it. The idea is they don't want people to cheat government twice. If you didn't pay VAT, then you should not take a deduction for it. So what that means is now become very important for your vendors to charge you and you pay VAT. And where they don't charge you for any reason, you have to self-charge yourself. The VAT laws allow you to self-charge. So you got a repairman to do repairs, you collect fees, he didn't charge you VAT because this is a small business. You have to self-charge yourself VAT and pay it on his behalf or on your own behalf to the FRS, or else you may not be able to get a deduction for that expense, right? For those of us who deal in forex, import companies, either you're importing goods or services, you are not allowed to take in FX expense more than the CBN rates. So for your accounting, in your financial statements, let's say you wanted to buy dollars to import something or pay Amazon because you use their web service. The official rate is 1,000. The black market is 1,2. But you could not get official rates, so you bought at 1,2. So in your financial statements that you prepare, you will put your costs, let's say it's $10. So it will be 12,000, 1,2 times 10 as your cost of Amazon. But for tax, your cost will be 10,000. Because as far as they're concerned, that extra 200 naira you paid per dollar is your business. So you're not going to be able to deduct it for tax purposes. So if you lead to a tax loss, you will lose 30% of it. We cannot deduct input VAT from output generally. It was restricted before, but service companies, for example, if you buy a laptop as a service company, let's say let me use one, let's say Excellium, very good example. Excellium, for instance, has staff, and they use laptops for their work. If they had bought those laptops, the person selling laptops will have charged them VAT, and they will have had to expense the VAT in their books, increasing their costs because they could not deduct that VAT. But now that has changed. You can now deduct that input VAT. So what that means is when Excellium buying a laptop from January 1st for staff, the VAT that they will charge on that laptop, when Excellium also provides services to customer, on that service they will put VAT. Before they pay the VAT charged to those customers, they will deduct the VAT of all the laptops, all the repairs, and different things that they've been charged VAT on. So that way, VAT no longer hits their expense line, which gives them more profit, they can pay more bonus to, employees doing well like Paul, right? So that's the idea around input VAT. Do I still have any more minutes left? Can I go ahead or I stop here? Paul?
Yeah, I'm with
Okay.
you. I'm with you.
I can continue?
Yes.
Okay. All right.
Please go on. Let's go on a bit because I know there are some, but the webinar is ending at 12:30. So we would shift the question and answer to 12:15 because I see that there are a lot of explanation. You still need to go on.
Okay, should we just go to question and answer now? Because so that people can have time.
Okay.
And have, yeah, let's just go to question and answer.
Okay.
Yeah.
Okay, let's do the question and answer. Let's take some of the questions. So one of the key questions.
Please go ahead.
One of the key questions, I'm with you, sir. One of the questions is the relief, right? Let me read that question.
All right.
Okay, said from Abdul Rauf,
Okay.
right? Says, kindly explain how one can enjoy the rental relief allowance when it takes effect.
Okay. So I will start by saying that one of my issues I have with the tax laws. By now, we should have been having what we call clarification circulars. For the past 3 years, before this tax law, before last year rather, since 2019, Nigeria, I think we had has been having finance act, where we use like a finance act at the beginning of the year to set the way we want taxes to be, before we now had this whole one where we are doing a whole overhaul. And what usually happens is that when those finance acts are released, the FRS and states release circulars saying that, oh, this is how we want to implement it. We don't have that yet. So I may not be able to answer exactly, what they plan to do. However, based on what the law says, where you pay rent, as a payer of rent, based on what I am doing, let me put it that way. Let me see what the law says. I tell my employees, not my employees, the employees of the organization I work for, at on the head of tax, and say, send me details, receipts, and rent agreements for your place you are paying rent. So when I get those receipts, I input in their payroll the amount of rent relief that they have. So if somebody sends a receipt of 1 million, I just input in the payroll that they have a relief of 200,000, and then the relief would automatically, reduce a little bit their tax payable each month, right? The amount is annual; it's not a lot, right? If you don't pay rent, you're not liable to the relief. If you live in a place where somebody else is paying rent, you're not liable. The idea is those who own their houses, live in houses that they own, you are too big for us to start subsidizing you. Personally, I think the 500,000 is very small. It doesn't really do anything. It doesn't make any difference in the pay calculation. It's very small amount, but it matters to some people, right? But if you have mortgage, so you bought your house, you own the house, but it's under mortgage, the amount you are paying as interest on that mortgage is also a relief. You can deduct it on the house you live in, not just any house, right? You live in. So for homeowners who have mortgage, then they can deduct it. But generally, the relief just applies to those who pay rent as an employee. You provide it to your HR. So HR should be your organization. HR should reach out to you. Your organization HR, I've worked with them to reach out to all staff to provide the amount of rent they pay, the asset of residence, the receipt of rent, and where possible rent agreement. Receipt is most important, but rent agreement, if they have it, is also fine, right? Because I know some people have outdated rent agreement. So that's basically how it will run. But I expect states to release clarification, especially LRS, on how they want the specifics to be. Some organization will just give everybody 500,000 relief because it's not a lot. Just move on because it may be problematic if you have a lot of employees to start doing 20% of this, 20% of that for your payroll, right? So it depends. Yeah. I don't know if I answered the question or I give some idea.
Yeah, I mean, you did justice to that question, right? From what you said so far, you made mention that the tax is to prompt people to be more accountable, right? So the individuals are the one that there is more input from them to be very conscious of their tax, to be able to report, right? So there's another question here that says, I run a spa and hair salon. Do I need to be charging VAT from client henceforth since we are offering services?
Okay, like I mentioned, it depends on what your revenue threshold is. Small companies, okay, I didn't put VAT there. So small companies, that's 100 million naira company. So if your spa business does less than 100 million naira in revenue a year annually, then you don't need to charge VAT, and you don't need to register for VAT. But once you cross that threshold, irrespective of how your company is registered, either registered as a partnership, a business name, a limited company, a private trust, it doesn't matter. Once you are having services that you charge for, which is spa, because spa services are not exempt. So there are a list of exempt services under the VAT Act, but spa is not one of them. So once you know your threshold will pass 100 million a year, you have to start charging VAT. So let me digress a bit and say this, right? Which is one of the issues I have with Nigeria. I'll give you an example of a live case I had. And please, what I'm about to say next, I know we are live, is my personal opinion. Totally personal opinion. So there was a client, who took advantage of some, this is a story, not happened to me personally. I heard the story, a client who took advantage of a waiver of penalty and interest to become tax compliant and file taxes and paid heavily. That client, the people within their industry, his friends and people in their industry were telling him that, oh, I think you're stupid for doing this. Are you a stupid person? Why will you go and, voluntarily go and file something they didn't even come and ask you for? And the person said, I don't take advantage of this. My tax consultants actually take advantage. And the person did and filed a lot of money. I'm talking a lot of money, right? It's been, how many years now? It's been 5 years since that regime of the penalty waiver happened. And nobody has come for defense. So now he actually does look stupid. Because I'm sure each time they go for golf, because I'm talking high net worth people. Each time they go and play golf or they travel out for some party or something, they keep taunting him that maybe we told you, So I think, and I'm not talking to you as taxpayers, I'm talking tax authorities, I try to talk about it anytime and I have the occasion that see, it's very important that this new regime, I wrote it on my Twitter yesterday, has to be fair. It won't be good for you now as a spa owner to start charging VAT, and the person who is in the next building, say you're in Lekki, where there are like 25 different spas, and the next person not charging VAT, right? And nothing is happening to that person. It means the tax authorities and the federal government and state government have put your business at an advantage. So yes, you are liable to charge VAT if it's more than 100 million. And I hope that this new regime, there will be more fairness, more equal in the tax. It should not be unfair for some people to be suffering tax. It's happening now. As an employee, I pay tax. And I have friends who are not employees who don't pay a dime of taxes. And some of them earn as much as 10 times my income. And I pay heavily, they don't pay anything, and nothing happens to them. 10 years they've been working nothing because they're outside the tax, which is unfair to me, So hopefully we get a fair system, and everybody gets to, tax their fair share so that it's fair for all. So I hope I was able to answer your question of what I said and did not say.
Okay, thank you for that. There are more questions, right? So we'll take one more questions again. And what we'll do is I would leave it to the audience to decide. Do we get you to keep explaining more, right? Because there is a lot that needs to be covered, right? So we'll take two more questions, then I'll let you return back to the
Okay, that's fine.
slide.
That's fine.
Okay, so if you want him to keep going and keep explaining more, please, I want to see your reactions, right? Please react in the comment section. I want to see keep going in the comment section and you'll react, right? So the next question here I have is, let's see, we are from Kayode Ulukosi. It says, will VAT fiscalization rule apply to small and medium companies starting from January 1st, 2026? Let me read that question again. Okay. No.
Yeah, it won't apply to them for now. So they are trialing with large taxpayers. MTN. So MTN in Nigeria, MTN is our biggest payer of VAT in the entire Nigeria. The company with the highest VAT paid every month because there's VAT on data services, and MTN is like one of our largest companies. So because they're the largest taxpayers, and they're also required by law to withhold VAT from their service providers. So unlike other companies where if you have a company and people provide service to you, they will charge you VAT and you will pay the VAT together with the amounts, their fees to them. For MTN, if you provide service to MTN, you will charge them VAT, but MTN will not pay you the VAT because they are very big. FRS use them as a point of collection of VAT for all their service providers. So don't pay the service provider, just retain it and pay me. So MTN pays a lot of VAT every month. So they have trialed this e-invoicing approach with them over the last 1 year, and it has worked. I was in a session where their e-invoicing manager said they are doing fine with it. So the FRS said that, okay, they can work with MTN, our large taxpayers. Let's trial it with the large taxpayers, other large taxpayers. So, the FRS is into large, medium, which I hear is now emerging tax office and small. Right? So they are going for large first. So large are the banks, the big consumer goods, I don't know why Guinness only keeps coming to mind because I saw them online somewhere. But the big companies that we know in Nigeria, they're the ones in the large taxpayer group. And they're the ones. For instance, as a tax manager at Moniepoint, I'm also working on e-invoicing because we're in the large taxpayers group. For small and medium, not yet. Eventually, yes, maybe middle of next year, maybe 2027. But for now, no.
Okay. Moving on. Please, I'm not seeing those comments. I'm only seeing two people. It's only two people that want us to keep going, right? I want you to encourage our speaker so that he can continue to explain further, right? So please. The next question, right? This one says, how would a man and a wife, right, husband and wife, share their rent relief if they both earn above 1 million? Would the landlord or landlady be reporting to tax authority? Please, more clarification on rent relief.
Okay. So if I get that question right, they live together. So there are two scenarios, right? They live together, one person pays the rent. They live together, both of them pay the rent, right? The first scenario, husband and wife live together, only the husband pays, only the wife pays, then only the husband or the wife will get the rent relief. They live together and they share it, they pay it together. So they're supposed to get relief on the basis of what they've paid. It's on rent paid, right? So whatever they've paid, they get a receipt for it. And the husband will say, oh, I pay 70%, and tell his employer, the wife as well, because both of them, they need to be on the receipt. However, in practice, what I think will likely happen is that the wife will go to a place of work with the receipt that carries both her husband's name and claim the rent relief. And the husband will also go to his own place of work, and claim the rent relief. The HRs of both places, unless they're related companies, don't have any way to communicate and say, oh, you use it or I've used it, So most likely couples like that will use it in both places. But what should happen, what should happen according to the law is on rent paid. What you paid, get a relief for it. If you paid everything, you get a relief for everything. If you paid half, you get a relief for half. That's how it's supposed to work. And in terms of the landlord, I did mention that the relief is small. In fact, I think it's too small. 500,000 is a small thing for rent. Maybe in rural areas, it go a long way. But if you want to give me relief for the rent I pay because housing is now expensive, then give me something substantial. But I think the entire idea around this rent relief is to actually get landlords' data. That is why HR, if you are here as a company, either you're a financial and a tax person, you need to go back to your company and talk to them that you may need evidence, because I think the state will take this very, very important. If your rental income is subject to tax, both withholding tax and companies income tax. Although as individuals, you cannot withhold, so that will be companies income tax. But most landlords do not declare on their property. Property is one area that Nigeria has mixed out on taxes on for a very long time. For most other countries, they get a lot of taxes from property. It's either tenement rates, land discharge, and the likes. So the idea is we want to start getting details of landlords. So if you tell me you are living in a place and you pay 10 million as rent, I want to get details of your rent agreement and receipt. So you carry landlord details, and I can go to landlord and say, somebody somewhere working in Moniepoint said they paid you 10 million naira last year for living in a house that you built. When you file your tax returns, why do we not say me 10 million naira rent agreement, rent income here? Come and explain. So that's the entire idea behind it, I think, personally. You should get landlord details. If you're a landlord, you have to you have to start tax planning to know what may likely happen next year. Yeah, I hope I answered the question.
Okay. I hope you answered the question, right? So, my audience they do want you to keep going. They can't get enough of this explanation, right? So, I will take one. I will take
Okay.
one last question, and I'll let you keep going through the slide, right?
We're still finishing at 12:30.
They want you to keep going.
Okay.
Extend the time
No problem.
to 1
Yeah, we
o'clock?
can extend a bit. I have a
Yes, so we
meeting at
extend
about
to
like
1 o'clock.
12:45. Yeah.
Okay, 12:45. 12:45
If
works.
everybody people are down
All
for it.
right. So, please, your questions. 12:45. We are Mr. Adedapo is leaving us. Okay. So, one last question, and I'll let you go back.
Okay.
Okay. We have one from coming. Okay. So, where is small company? Right. This is from Innocent Samuel. Where is a small company? Why didn't charge me VAT? I think you've answered this because it's still within the threshold. Should I, company X, do self-charge on that transaction?
Yes. Because at the end of the day, the self-charge rules are there in the law, right? It's clear as a company. If a company doesn't charge you VAT, you self-charge yourself. And because it's not tied to your expense, you won't be able to claim that expense if there's no VAT paid. So what the FI wants to know is, where's the VAT? Either you paid it or you paid it to the person who charged you, or you paid it yourself. You also need evidence that the VAT was paid, before they can allow you to take that expense. Of course, that will come out doing audits and to be to the extent of the team of the FRS with you. Some of them may go very granular, some of them may just pick your bigger expenses. We are a very big company. They cannot be looking at all your vendors. They may just do materiality to check that, okay, you regularly pay your VAT for you to claim expenses. Yeah. Okay, do we go ahead now?
Yes, please go ahead.
All right. So I talked about the deduction not allowed with VAT and the expense, the CBN expense. Okay, I think I've also touched on output VAT deductible for all companies now. And the good thing about it is if you are in an industry where you don't sell as often, like I mentioned, say your industry is construction or real estate or shipping, you build ships or whatever industry where you don't sell monthly, like container products, you can still carry on that output VAT for 5 years, right? You can also get a refund. So the law now says that you get a refund within 90 days. So in a month, I bought a lot of inventory, a lot of raw materials. And all those guys who sold the inventory and raw materials to me, they charged me VAT. My VAT input, that's my input VAT now. My input VAT is 200 million. But I was only able to sell VAT, products that brought me VAT of 50 million. It means this month I have a huge difference. I've paid so much more VAT, that is 200 million, than I have charged. So I'm in the negative of 150 million. The law allows you to get a refund of that 150 million because that 200 million you've paid is not with you anymore, right? So it's going to be people that sold stuff to you, so you don't have it in cash. So you go to the FIS and say, "Oh, I bought cement as a raw material from Dangote. Dangote charged me VAT of 200 million. This month I was only able to charge 50 million, on the output, whatever output of cement is. I don't know, sculptures, for instance. I was able to charge 50 million, right? So I need you to give me that 150 million balance that Dangote collected from me. And FRS have 90 days to give it to you. However, when I was preparing for this session, I was trying to read this, because as tax professional, it's very important that we read the lines, no matter how much you think you know. I discovered that what the law actually says is FRS has 90 days after they are satisfied that you have a refund. And I think, I hope the FIRs don't see that, because that brings some ambiguity. I'll always take FIRs to be satisfied. If I submit a claim for refund today, can the FIRs be satisfied in 1 week, 1 month, 3 months? If the FIRs is taking 6 months to validate that I actually have refund, then the 90 days becomes useless because it has been defeated. So, but hopefully it works. This is something that has not worked in Nigerian tax before. Even Taiwo, the drafter of the law, said in his over 20 years career, he has only gotten refund for a client that was exiting Nigeria once ever. You hardly get refund, but hopefully it works. The good thing about it also is that excess VAT, you can use it to offset other taxes. How that will work as well, we need some clarification. So if you have, let's say the month that you have excess input VAT is June, and your CIT is due in June, instead of going to FIRS and say, give me a refund, I just go to FIRS and say, oh, my entire CIT for the year is 500 million, but you are owing me a refund of 150 million because they overcharged me. So I'm only going to pay you balance of CIT of 350 million, something like that. But like I said, we expect some clarification of how that will work in practice. There's now a minimum effective tax rate. Somebody raised their hand. You answer question. Should I just go ahead? There's now a minimum effective tax rate. But this one applies to very big companies. So first off, there's a current minimum tax provision. As a company, let's say you don't have taxes to pay, CIT, that's income tax, you pay minimum tax of 0.5% of your gross income, as long as you're not a small company. So it's like an at all tax, at all. But the idea was, why will we ask you to pay additional 0.5%? Why you not even make money? You are saying that you came to Nigeria, or you're in Nigeria, you did business at a company during the year. The expense on that business is more than the income, right? So the income you got in that year is 200 million, but your expense is about 400 million. So you're already in a loss of 200 million. We are now saying you should pay minimum tax. The question is, where do you want to get the money? It means you go and borrow, which is unfair, right? So they have now scrapped out that entire minimum tax, provision. So if you don't have profit, you don't have profit. You don't pay any tax. However, they have also, like I said, they are dealing for small company exemption, but bigger companies have more things to do. So there's now a new minimum tax, or minimum effective tax rate, that they call it. And this applies to any company that is part of our M&A group. M&A group means multinational enterprise. A member of the group is in Nigeria, and that member is in Dubai or whatever. That means you're multinational. Your services extend beyond the borders of Nigeria. If you're part of such group, you are in this minimum effective tax rates. If you have a turnover as a company of 20 billion naira and above, you also fall within this minimum effective tax rate. So only those two companies, two sets of companies fall within this. And if they're not a part of that, then you don't have any minimum tax to pay. What the minimum effective tax is just saying is that after you have taken all your exemptions, after you have taken, there's some income that are not liable to tax, say government bonds, invested in government bonds, that income is not liable to tax. Dividend is franked income. Franked means if you thought they were withholding tax, and that's the final tax, no additional tax. So you are saying after you've made your adjustments to your accounting income and profits for the year, the minimum effective tax rate you should have is 15%. So they are saying, worst case scenario, as a big company or a multinational company, you cannot pay more than half of the actual tax rate. Our tax rate cannot be 30%. And then you're seeing your own, because you're making some adjustments, you're going to invest in things that is not taxable, or you've done some, quote unquote, by why you accounting, wherever you're accounting, you're not seeing your own tax rate, effective tax rate is 10%. That can't work. So they are saying it must be at least 15% because you are too big for you not to bring money in, and you've made too much money in Nigeria for that year, 20 billion and above, right? So that's the idea. So the new minimum tax would affect the big players. The old ones have been deleted. There's also the introduction of the tax ombuds office. So if you are in a dispute with the tax authority, either state or federal, and you where's the point where there's an impasse, you can't go forward, you can't go back. The tax authority can issue what we call a NORA. A NORA is a notice of refusal to amend. what the tax authority is telling you is that, see, we've been dragging this audit for long. We've gotten to a point where we don't agree with you and we don't want you to object to us anymore. We're just writing letter back and forth. We're telling you that this is our final amendment notice and we are not going to move on from this. You have two options. Either you go to the tax appeal tribunal, either you pay the money, or you go to tax appeal tribunal. But you and I know that going to court in Nigeria is not cheap. You have to get lawyers or tax consultants to get, to represent you. So now what we've done is to introduce the Office of a Tax Ombudsman. And when I say we, I mean the committee, not me. What this committee does is to liaise with the tax authority on your behalf. So when the video is NORA to you, or the FRS team handling your audit is doing anyhow, or they are harassing your estate, maybe Kaduna State or Edo State or whatever state is coming to you and they're harassing your business premises, you can go to this tax authority's office, and shout there like, you people should help me. You get, the tax authorities are being unfair to me, and they will take it up. So they serve as an independent arbiter, independent reviewer to help you resolve complaints, taxpayers. So it's a low-cost initiative that's now been introduced to check the powers of tax authorities. So they don't do any out to taxpayers. So it will be helpful to small and medium taxpayers who cannot afford TAT. A chairman is already appointed, Dr. John Wabizi, and I don't know the readiness of kickoff, but sometimes next year, I think the office should kick off and taxpayers should be able to enjoy their services. Hopefully, implementation is seamless and taxpayers get value. Sorry. Okay. Let me just go back this. Regulatory reporting. People are talking about banks. I keep telling people that nobody is coming to your bank account to deduct your money. The provisions that they are citing around the fact that banks and just FRS can direct banks deduct your money, those provisions have existed since 2007. Now, I mentioned at the beginning that not everything in these tax laws are new. It's like a consolidation. Some things are deleted, are old, some things are introduced, but generally it's just codifying all our taxes into one. So some of those things are there before. It's not new. So that provision is not new. It has been there for 18 years plus. So if the FRS did not, and like I also mentioned, FRS has nothing to do with individual income. That's your state. So if you put this together, nobody is coming to your bank account. However, the law gives the tax authority the right to go and get your bank details without your permission for data gathering purposes. So if you say your entire income in the year is, 500 million, you can go to all your banks, secularize them, and write to them and say, give us the bank account for Dapo Limited. But then they gather all the bank accounts together and they come and meet you and say, but your bank account shows that there was an inflow of over 2 billion. So we're declaring 1 billion if inflow of 2 billion. So you now be the one to explain that, out of that 2 billion, not everything was income. Some of them is our shareholders that give us money. So them is dividends. So them is gift, So you don't just explain and say that's how we have 1 billion income, 1 billion income. So they can get that details. And they've been doing it for years, right? So this is also one of the things that banks are now required to do. All new accounts, people that open bank accounts and existing accounts, if you're an individual, you have 25 million naira and above transaction in the quarter. And if you're a corporate account, you have 100 million naira in the quarter. The bank, or not even just bank now, financial services company. So your banks, your stockbrokers, your investment houses, whatever company generally licensed to take investment of people, and banks as well, are now required to give that report to the FRS. Like I mentioned, there's a lot of misinformation online. People are scared, but it's just for data gathering, right? If the FRS even come after anybody in terms of locking accounts, it's big companies. They're the ones that they have issues with, right? Not individual taxpayers. So that's that. Then I mentioned the development levy. So we currently have so many levies all over the place. There's an education tax of 3%. There's a national levy. There's a police trust fund levy. There's a NISTA levy. So when you do your income tax for the year, there's a lot of levies here and they're 1%, 2%. So what they've done is to delete all those levies and codify them together at a single 4%. The committee intended that this 4% will go down to 2% in 2028, but the National Assembly deleted that. So to remain 4% until there's an amendment to the law. So it replaces all the numerous levies. So what happens now is when you file your income taxes at the, for next year, you will just pay company's income tax 30%, single development levy 4%. That's all, 34%. So, like I said, in the impact, the impact, small companies are exempt from this, So the impact will differ depending on what you pay currently. If you're a company where, because those levies I talk about are consolidating, it doesn't apply to every company. I'll give you an example. The NISTA levy, which is the information technology levy, applies to banks and telecommunications guys. So if you're in the consumer lending, so you're in the consumer service, in the consumer goods space, you're not having paying NISTA levy, So depending on where you stand, if your levies were more than 4% as at now, it means the development levy favors you because you come down to 4%. Say your levies are like 6%. If you had education tax, NIDA, and the likes. But if currently all your levies, because you're operating an industry that they don't pay levies like that, say you're operating e-commerce, you do logistics. Logistics doesn't have as many levies. I'm not talking small levies that they charge them, all those guys on the street. I mean in terms of FRS levies like a bank would. So it means for a e-commerce company, it's likely that this is going to be more burdensome for them because it means their levies will come from like maybe 2% or 3% to 4%. But that's just what they try to do to kind of make it neat instead of having so many levies. So what will now happen is when you charge this levy, everybody that they had different levies will go and share from this 4%. The tertiary education tax fund, all of them will go and share from the 4%. The next is for oil and gas. I'll just briefly talk about it. For oil and gas, some filing is moving from annual filing to monthly filing. Nigerians want to collect their money, faster. They're waiting for annual tax like other companies because they're the ones that are the livelihood of the economy. So for those who file petroleum royalties, mineral royalties, and then for non-resident shipping and airline companies as well, you have to file and pay taxes on a monthly basis, your income tax, rather than annual basis. What else? Yes, this is also important. There are joint
so,
audits and increase. Okay, time is gonna be okay. All right.
No, so
That's fine.
sorry for interrupting you. Right. So
No problem.
this wouldn't be successful without our audience being available. So in next 2 minutes, right?
Okay.
I want to take 1 or 2 questions for the audience before I let you go and
Right.
12:45,
Okay.
right?
That's
So
fine.
I want to give a few of our audience opportunity to ask questions. Right. So the webinar won't be successful without them. I mean, they've been here for over 2 hours. So I do want to give some people the
Thank you so
opportunity to
much,
talk to
everyone.
you.
Okay.
Yes. So I'll be taking the first question from okay, that wanted to ask a question. I think he's back. So I'll be taking the first question from him, right? So please, if you do want to ask a question, this is the opportunity.
Okay, yeah. Good afternoon. Can you hear me?
Yeah.
Yes, I
You're
can.
up, Mr. Dauda.
Okay, yeah. Thank you very much for this. So on the issue of CGT, I need your clarification on the areas at which
On the issue of what? I didn't get that.
CGT.
Okay, all right.
Most developers are now selling houses at the moment, and
Okay.
do they factor in CGT when they are buying those houses, or who make the payment for CGT? That's one. Then two, for shares now, you said shares has a threshold where they're able to calculate the CGT element of it at 10% rate. So is it the bank that will be able to classify that at 10% or the buyers of that shares? Then is it at the point of public offers or when you have right issues, you have bonus issues and the like. So does those elements factors does it affect CGT? I have right issue in a bank, in a company. I think I have a bonus issue. So will they be calculating it on different amounts, or they'll calculate everything at a whole?
Okay. All right. Okay. Let me take a question after the other. Hopefully, I don't miss out any. Just start from the first on the developers. So to give a bit of background of capital gains tax for the company's income tax. So capital gains tax is on items that are mostly one-off assets, which typically would involve buildings, right? Because it's one of. However, for a developer, those buildings are not likely to form CGT. They will form part of his income tax because his own inventory or his own goods is building. Let me use another company to give an explanation. For a stockbroker is people who help you deal with shares. For me and you on this call, our sale of shares is just a CGT because we are not in the business of buying and selling shares. It's just investment. It's things we do to make money on the side. Right? It's not our income. So for me and you, shares will fall under CGT. But for a stockbroker, that's what they do every day. So shares for them is income tax. I don't know if that's clear. The same thing for a car seller. For me and you, if you sell a car, it forms under CGT because an asset. So sale of car is sold to CGT. And most people, even if you're very rich, you have 20 cars, it's not something you do daily. But if you buy and sell cars, it's not going to be CGT. It's going to be CIT because that's what you do. So for a developer, that's what they do, right? So it's going to be CGT. But just to be CIT rather, because that's what brings them income. That's what they do for income. But just to answer your question on the CGT, where you sell, the liability for CGT lies with the seller of that item, the person who is receiving the proceeds. You are supposed to self-declare, right? Your CGT. So even when you sell shares on the Nigerian exchange, when you sell the shares, they are going to give you your full amount for the sale of shares. You are not the one when you are filing your income tax returns. You put it there that I also earn money from shares. However, the committee has mentioned that there may be an introduction of a withholding tax regime under CGT. Currently, the only item we have for withholding tax under CGT is compensation for loss of office. Compensation for loss of office is treated differently from employment income because it's one-off. You are compensating somebody for sacking them. So it's a capital transaction. So if you are paying such an employee, you deduct withholding tax, but it's CGT. Apart from that, every other kind of CGT currently, there's no withholding tax. So the person buying from you does not have any obligation, to withhold. You are the one that will self-declare. But they will likely introduce something. So that probably people like stockbrokers. So when you go to Nigerian exchange, you buy Zenith you buy 30 million naira shares of Zenith and you sell for 60 million naira. Your stockbroker will just take that 30 million gain and, withhold something, maybe 10%. Then you pay the balance when you pay income tax. In terms of the value, so for when it comes to shares for capital gains in Nigeria, it's still very simple. Either it's nominal shares, bonus shares, we use the value of what you bought, the actual amount you paid. Where you do not pay any amount, say it is bonus, we'll use the market value after the day. So if I issue you 10 bonus shares of Zenith Bank today, right? And for calculating your costs, and after today, Zenith Bank shares is 50 naira, as an example. It means your cost is 500,000 naira. Sorry, 500 naira rather for today. So it's a very simple CGT regime that we have. It's nothing eccentric, so to say. Just your costs. Where you don't have costs, we use the market value as at the day you bought. I hope I answered your question.
Yes, I'm sure you did. Right. So you were about to say something before I interrupted you. After you talked about the oil and gas. So I'm sorry for interrupting you.
I remember. Maybe it's the next thing on the agenda, which was the joint audits, and that penalties are now very increased, and it's something that people should note. One thing that the new tax law have done, and the committee has been quiet about it, not saying anything about it, I don't see them talk about it, is that penalties are now very huge. If you do business with somebody who is not registered for tax, for instance, whatever proceeds you get from that business with that person, either it's a service or whatever it is you do, you are going to pay penalty first of 40%. So imagine you have somebody that your business is together in a year, the service they provided to you in a year is, say, as a business, it's probably 500 million naira, and the person doesn't have a thing or something, and you just move on. If the tax authorities get a hold of that, you will first pay 40% of that 500 million first as penalty before we now start talking about interest and penalty separately, which is the normal interest and penalty that apply when they do tax audits. A lot of things that used to be small amounts, you now be seeing 10 million, 1 million. Some of them even accrue daily, you know. I was looking for a file during this stuff, I couldn't find it. I used to have a list of the new penalties. It is very long. There are now so many things that have penalties, and they are very plenty. Some accrue daily, 1 million here. So what I'm saying generally is, as businesses going to 2026, you have to be very careful how you do business, especially if you are doing a business that is within the purview of the tax authorities, and you usually do audits a lot. It means that if you're not careful and you're not deliberate about these new tax laws, the penalties, in fact, they will never need to do too much audits. The penalty and interest alone they'll be getting from you will be more than a lot of of your monthly income. So just generally, it's important that we sit down, read this, know how it applies to us, and ensure that we are there. That's what I have to say.
Okay, thank you so much for that clarity. Thank you so much for that clarity.
So I have to run now. Maybe late for where I'm.
Yeah. You took your time to explain a lot, right? So thank you so much, sir. Please in the comment, please let me see you say thank you to our speaker. He took his time to break down most of this. Right. So thank you so much, sir. Please, I want us to say together thank you in the comments.
Thank you, everyone.
Right. I know we couldn't touch everything, but please let's thank him. Yeah, I'm seeing Friday. Thank you. Yes, thank you so much, sir. Thank you so much. Right. Mr. Adedapo is also a writer. He publishes on Medium. You should go and check his Medium page. So to read some of his articles where he further breaks down some of these key concepts.
Thank you.
All right, so I'll be freeing you to go, Sana.
Thank you very much.
So,
thank you, everyone. Yeah.
Okay, so as you all had, penalties are huge, right? Imagine paying 40% of 500 million before you now start to talk about the real penalties you have to pay. And that is very important, right? We do not want you to pay penalties, which is part of the reason why we put this webinar together, right? We are complaining about the cost of doing business. And not to talk of you now paying penalty to include it with your cost of doing business, right? So as you can see, what we do here at Excellium is we help you, automate, set up ERP and finance system that helps you do the heavy lifting, right? So you do not have to, rack your head around running your business. Like I said, there are 4 angles, 4 pillars that hold your business, right? You have to control the people that are helping you push your vision, and the customer, right? You take care of the people taking and pushing your vision, the people that you seek to serve, your product and services, which is the second pillar. The third pillar, your finance, right? Where is the money going? You need to track where the money goes, right? If you cannot account for where the money goes, then how do you know if you are running at a loss or you are running at a profit, right? This is a wake-up call for businesses, right? It's time to safeguard your business against penalties, and the only way to do that is with software, right? You can't, it's no more a luxury. Software is no more a luxury. It is as essential. It is your partner for growing business, for upscaling your business, right? So we said we have special exclusive consulting session for those businesses that joined us first. The first 20 people that joined us, right? We took down your names. We'll be reaching out to you, right? That's to appreciate you for being on time, right? So you don't know where your blessings might be next, but be on time for special events like this, right? So we'll be having our closing remarks from our MDCU. She has some few words she wants to share with us. Over to you, ma'am.
Good afternoon, everybody. Well, thank you for being a part of this. Definitely, we have learned. It's definitely a new phase for every business owner, 2026, and it's very key that we are getting knowledgeable about how to navigate this system in Nigeria. But for us in Excellium, we have been in business for about 13 years, and all we have been doing is implementing software solutions for businesses. Right now, it has become very, very imperative for business owners to have software solutions, no matter how small your business is. I remember this far owner talking about, oh, am I supposed to charge that? And like the speaker said, oh, when you are seen as a small business less than 100 million, how do you know when your business gets up to 100 million? If you don't have a software, of course, using Excel or keeping books, your receipts, it does not tell you just at the tip of your fingers that you're about to reach 100 million. And the moment you get to 100 million, you are expected by the tax authorities. Besides that, even the law says whether you're up to 100 million or not, you're still required to file returns at the end of the year. So please, we just think our own contribution to this current debate or discussion is to remind everyone that there's a need for you to have software solutions for your businesses. We're currently running a promo on our POS software and Zoho books for small businesses. So just to be able to contribute our own quota. We look forward to hearing from you, and then for all of us to be able to, our businesses to grow and go through this period unscratched. Thank you for coming to this program.
Things that are not typical income. Sell houses, sell cars, sell shares, and things like that. When you sell them, you move your cost of buying that's and then you remove any incidental costs. Say you bought an appraiser or valuer, move all those costs, and then you move it from the selling price, and then you tax the balance at 10%. Further down from January, that capital gains tax margin will be taxed at the rates of your income tax. If your income tax is at 30% as a company, means you will now be paying the capital gains tax at 30%. For an individual, the income tax rate is 15% or 20%. Means whatever capital gains tax you're going to have will be at that same rate. So whatever rate your income tax is,
is it that your capital base will also be taxed?
Yeah, so thank you so much for joining us. You can follow us on our socials, on YouTube at Excellium NG, on Instagram. You can, like I said in the beginning of this webinar, it is Blue November, so it's not too late, right? The whole of November, we are giving out 30% off setup and training on our solutions. Terms and conditions apply, right? So, visit our website, www.excellium.b, and, send in a request for consultation. Right. Special people came in. I've not forgotten you. We have something special. The recording of this webinar would be made available, and you definitely get an email. You get it in your email box, right? And also, if you are not following us on LinkedIn, I mean, how would you be aware that you've uploaded the videos? We'll be breaking down some of what is said again further, and we'll be sharing it on our socials, right? So follow us on Instagram, follow us on Instagram at excellium.biz, follow us on Twitter at excellium.ng, follow us on Facebook, right? And also follow our founder. Our founder goes further to break down some of these concepts. We had so much questions in the question and answer question that we couldn't treat all your questions, right? So this discussion cannot stop. The discussion needs to continue. We all need to get more clarity. I saw some questions on rent and relief, and I know some people still have questions on rent and relief, right? So follow Mr. Adedapo on LinkedIn at Adedapo Adeduro. Connect with our founder, Aflake Akingbade, on LinkedIn. She shares insights that I don't know if you are not following now. I don't know where you are getting your insights to run your business, right? So stay tuned for our next upcoming webinars that we still have in store for you. Thank you very much.
It's a mechanism works inputs and output basis, right? So whatever input be it you have such raw materials, but to produce that juice, the packaging, the juice concentrates, or the fruit, whatever it is, you need to deduct it. But every other kind of VAT, input VAT, you can't deduct. And for service company, you can't even deduct VAT at all. Input VAT, you expensive. So let me make that a bit more practical. Let's say, as a service company, you bought laptops, for instance, or you bought the service of a Balua. When you buy that laptop, whatever VAT you suffer on the laptop, when you charge your customer VAT, even though VAT is supposed to be an input-output mechanism, supposed to deduct whatever input you suffered from the output and pay the balance to government. The old mechanism or the current mechanism does not allow you to do that. So it means that you have to extend that VAT, increasing your cost because there is to do business. VAT mechanism works on so whatever input VAT you have suffered as such
raw materials but to produce that juice, the packaging, the juice concentrate, or fruit, whatever it is, you need to deduct it. But every other kind of VAT, input VAT, you can't deduct. And for service company, you can't even deduct VAT at all. Input VAT, you expense it. So let me make that a bit more practical. Let's say as a service company, you bought laptops, for instance, or you decide to be bad one. When you buy that laptop, whatever VAT you suffered on the laptop, when you charge your customer VAT, even though VAT is supposed to be an input-output mechanism, it's supposed to deduct whatever input you suffered of the output and pay the balance to government. The old mechanism or the current mechanism does not allow you to do that. So it means that you have to extend that to the concept of business.
From now, Nigerian is tax regime. And if you book something right now, you are about to be serious. Notice for late filing, interest and penalty, your bank account flagged, you are then at risk of seizure. Hereby others doesn't negotiate to enforce. And then you've got spreadsheets and notebook, and you are praying nothing breaks up before tax season. So believe me, you are paying with fire. Yes, you are. I knew that sentence was going. Now let me tell you something. What if your taxes are automatically generated from AI-powered accounting to returns? Imagine waking up during your compliance, no stress, no fear. That results are giving 30% off setup and training on all our business stress recovery this quarter, which will help boost your business productivity, improve your financial accuracy, and help you stay ahead of 2026 tax bill. Don't wait until another catches your card. Click the link below, grab your discount, and let's get your business ready for 2026 and beyond. Financial records could put your business at risk in this tax season. In 2 weeks from now, Nigerian is tax regime. And if your books are empty right now, you are about to be serious. Penalties for late filing, interest on penalties, your bank account flagged, you are then at risk of seizure. Hereby others doesn't negotiate to enforce. I know you've got spreadsheets and notebook, and you are praying nothing breaks up before tax season. So believe me, you are paying with fire. Yes, you are. I knew that sentence was going. Now let me tell you something. What if your taxes are automatically generated from AI-powered accounting to returns? Imagine waking up during your compliance, no stress, no fear. That results are giving 30% off setup and training on all our business efficiency recovery this quarter, which will help boost your business productivity, improve your financial accuracy, and help you stay ahead of 2026 tax bill. Don't wait until another catches your card. Click the link below, grab your discount, and let's get your business ready for 2026 and beyond. Financial records will put your business at risk in this tax season. In 2 weeks from now, Nigerian is tax regime. And if your books are empty right now, you are about to be serious. Let me next one. Quick question. Have you heard about the new tax reform? If you haven't, so listen to this. There are 5 things you do know about the new tax reform. 1, if you earn less than 800,000 a year, I have news for you. The new tax act has officially provided relief for low income earners, which gives you a breathing space over your finances. You're automatically tax-free if you earn less than 800,000 or 800,000 a year. Number 2, big companies. This one is for you. From January 2026, large multinational groups with huge global profits must pay at least 15% of tax. No more hiding profit in one offshore account in Dubai. Number 3, say hello to digital accuracy. The new Nigerian Revenue Service wants every business to go digital, from e-invoicing to digital VAT to real-time record keeping. So that's our accountant integrity line. We won't work anymore. If your books are incorrect, they will eventually catch up with you. 4, all my influencers, content creators, and freelancers, come closer. This one is for you. Those brand deals, YouTube payments, and TikTok income. Yeah, they now count as taxable income. Nigeria has officially entered the digital era. Every of your social media revenue would now be taxed. So get ready. 5, if you think moving your company abroad will save you, I'm sorry to inform you, but that's not going to happen anymore. Nigeria can now tax foreign companies that get value from Nigeria assets. In other words, like your offshore strategy, it doesn't work anymore. Now, here's the main gist. Every company must have clean financial records. From expenses to sales, everything must add up. No more paper files with copy stains and missing receipts, which is why Excellium is here. We help you automate your processes, while you track your finances, manage your expenses, and stay compliant without stress. So while others are panicking in 2026, you just reach the click as well. No stress for you. So reach out to us. Make sure you click the link in the bio and set up a free consultation to get one of our solutions that works for you. Bye. This is this one. Quick questions. Have you heard about the new tax reform? If you haven't, to listen to this. There are 5 things you didn't know about the new tax reform. 1, if you earn less than 800,000 a year, I have news for you. The new tax act has officially provided relief for low income earners, which gives you a breathing space over your finances. You're automatically tax free if you earn less than 800,000 or 800,000 a year. Number 2, big companies. This one is for you. From January 2026, large multinational groups with huge global profits must pay at least 15% of tax. No more hiding profit in one offshore account in Dubai. Number 3, say hello to digital accuracy. The new Nigerian revenue service wants every business to go digital. From e-invoicing to digital VAT to real-time record keeping. So that's our accountants with data line. It won't work anymore. If your books are incorrect, they will eventually catch up with you. 4, all my influencers, content creators, and freelancers, come closer. This one is for you. Those brand views, YouTube payments, and TikTok income. Yeah, they now count as taxable income. Nigeria has officially entered the digital era. Every of your social media revenue will now be taxed. So get ready. 5, if you think moving your company abroad will save you, I'm sorry to inform you, but that's not going to happen anymore. Nigeria can now tax foreign companies that get value from Nigeria assets. In other words, like your offshore strategy, it doesn't work anymore. Now, here's the main gist. Every company must have clean financial records. From expenses to sales, everything must add up. With copy stains and missing receipts, which is why Excellium is here. We help you automate your processes while you track your finances, manage your expenses, and stay compliant without stress. So while others are panicking in 2026, you just be chilling because what? Your books already speak for you. So reach out to us. Make sure you click the link in the bio and set up a free consultation to get one of our solutions that work for you. Bye.